So good morning, everyone. Wanted to welcome you to our November 4th Saturday. Really appreciate you all taking time this morning to join us. You've probably noticed in the reminder messages that I'd sent out. By the way, my name's David Ross. I'm the facilitator for today's session. You might have noticed in the reminders that went out from AAII and the local email distribution for me that we have the pleasure of having two presenters today. We're Doug Smith, as you know, our president, will be presenting, and you see the title slide there. We're also very pleased to welcome back Mike Sullivan. And so today, the way our format's going to flow is Doug's going to open up with some material he's going to cover. Then we're going to switch to Mike, and then we'll come back, and then we'll have Doug go over the normal charts and other market commentary, and then we'll transition to roundtable. It's pretty much our standard format. Let's see, are we at the top of the hour? I think we are. We are. So Doug, if you're ready to go, I will turn it over to you.
Okay, this is not your normal presentation. It kind of puts 2 months worth of slides together. Probably many of you or some of you have last month's slides. And there are a lot of slides, but they are more to give the impact of the comment rather than a whole bunch of comments per slide. So we will start. Well, I started out with a 1 page of material, and it's what David just had a minute ago there, on what changes the market. They were influences on the market.
I'm just putting your disclosure screen up there. Are you good with that? I can move on.
That's good with that.
All right, here we go.
Throw that in for Mike too.
There we go.
There were different things that influence the economy, which in turn influences the markets. And they were interest rates, demographics, debt, geopolitical. And we'll go through those, I think, fairly quickly. And if there are questions, so you can ask along the way or hold them, whichever. So might as well go on to the first one or the next one. Oh, well. Those are the ones that we're going to cover. First one is interest rates, and Benjamin Graham. Interest rates are very critical in figuring out evaluations, both for real estate, stocks, all kinds of different things, because basically people borrow money, and the interest rate they pay on their borrowed money lowers how much they're going to pay for the whatever asset they're buying. So this is in Benjamin Graham's book, probably the security analysis one. And you can see that basically, and I have an example that you've got the percentage across, and I have one for a 15% growth. At 1% that we've had, you can have a PE ratio of 169.4. At 4% interest, you've got 442 times earnings. That's about a 75% drop in evaluation for the same earnings. So that's one way, that an example of how rising interest rates can drop asset values, even though the companies are still growing at good, nice returns. So we go on to the next one, which I think says that, or it gives you an example. You've got it there. And then the other thing, what's likely to be happening with rising interest rates, stocks and bonds are fairly liquid. They compete with each other. And Peter Lynch had said that when you can buy long-term bonds that pay 6% more than what your dividend yield is on the Standard & Poor's, you sell your stocks and buy your bonds. There'll be people doing that. And it, basically 2%, 2.1%, you're looking at an yield, which the last 10 years sounds absurd that you could get that high, but that time may be coming, maybe next year. So next. So you have evaluations, as we've just presented, and then you have an interest rate cycle that ebbs and flows over approximately a 60-year period. And what you have and what we have experienced from 1980 is the declining interest rate cycle part of it. And that allows asset values to go up quite nicely. In fact, if you go from you would have the inverse of Graham stuff, where you have a 4% yield. Well, you had a 20% yield in 1980 and you go to zero. You can have a nice substantial increase in asset values without necessarily a whole lot of growth. But if you've got the growth, then you've got spectacular price movements, which we've seen. Sometime in the last quarter or two, it's reasonable to assume that the 30-year down cycle is over and that we're going to have 25, 30 years of rising interest rates. That basically puts a headwind on all evaluations. So it's a matter of, this will impact the values of both stocks and bonds. Bonds were being used in portfolios to offset risk of stocks, which when they are rising, when interest rates are rising, bonds have their own risks. And so there are a number of reasons why things are changing with this interest rate thing. This is a core change. Later on, well, there's a slide. Basically, bonds, you go into mutual funds, they do not have a maturity date. They can keep going down without a maturity date. You can buy, if you buy stuff, and I bought stuff, a 6-month yield of 4.56, I guess yesterday. 6 months from now, I've got that, I get all my money back. So if you hold assets to maturity, you'll get your money back to reinvest again. If you have it in a bond fund in that same time frame, you could actually have the bond price go down. So next. This is another example. This is a hold it, go back. Some of these charts, this is a 200-year of an interest rate, and it goes back to 1798. It's a historical thing, but it also substantiates the point. The interest, it goes to different heights depending upon what's going on with the government policy, demographics, geopolitical stuff, and innovation. So it's just there for entertainment. Or if you were a historian, unfortunately, I kind of like the history part of this stuff, which is why there are more slides than there probably should be. Next. The next issue is demographics. We have demographics in two ways. Again, one of them is the changing face of America, which, as you can see on the right side, well, white people would say here, we're going to be 47% of the population in 2050, whereas in 2010 we were 65% of the mixture of the population in the United States. The Hispanic is going to increase, and that becomes potentially an influence on the economy. This is one of the reasons you will have continual change political activity. And this, well, this goes into what Mike's going to go into. It's part of the fourth wave. You've got different generations, different mixtures of people, and they change the political topics over over the decades. So change in the mixture or the composition of a particular society will cause a change. And then there's also going to be a demographic change around the world where they're going to be Russia or China will have fewer people in 2100. You can go to the next slide. China's going to go from 1.4 billion people to 730 billion on this estimate. India will apparently, it will go actually, it'll go from 1.38 billion people today down to 1 billion, but it'll be the largest country. And then Nigeria, which comes up from number 7, will be number 2. And we are going to be going to number 4 with slightly more people. Basically brought about not necessarily by birth rate, but by immigration. So immigration is good if you can get people that want to work and give them a social security card. You got Nigeria coming into the world markets. They're going to have a different attitude toward different things. So another reason, the demographic shifts will be changing the political pecking order of countries to throw into the mix of changes. So you have composition of our country in different countries, and then you have number of people. Basically, birth rates have dropped. Japan, I think, already is negative birth rates, and they are declining. China apparently has got 50% fewer births than they had like 5 years ago. So population is going to be decelerating. And as the older people die off, then you're going to, well, that's one of the reasons why you've got fewer people. There aren't new people coming to replace them. This has economic implications for product sales. So next. Some of these charts are there just to represent US as part of a GDP.
Hey, Doug, hold on a second. I got someone to raise their hand. Got it. Somebody might have asked a question here. I don't want to let it go too far. Let me go look and see. Yeah, that was James. James Hapner. Did you want to comment?
Well, yeah, I was just going to point out that those population projections seem to assume that high birth rates turn into high populations, but for the African countries, Nigeria, Congo, Tanzania, they don't, they can't possibly grow that large. They don't produce enough food to support those population levels. They just have high birth rates, which apparently is being projected into high final populations.
You get high birth rates. Yeah. True. The implication potentially is that the industrial, well, it's like this whatever climate warming thing, the have-nots want the have countries to pay for their climate change mishaps or repairs. So you've got estimates, and interesting, and it goes to climate change. When you're going out 60 years, your estimates can vary a lot, but there are changes in the aging of demographics, and that has implications for the workforce productivity. The implication from what I saw would be.
Yeah, I agree that Japan and China are going to have shrinking populations. I just don't agree that those African countries are going to triple and quadruple their population.
No, well, you also have Malaysia in there.
Yeah.
The number of people, the point is, they're going to be more of the undeveloped or lesser economic countries growing, and the developed countries numerically by population would be shrinking. There are, it boils down we don't necessarily have forever increasing economic growth. If you got a lot of people that can't afford to buy stuff, you're not going to have much of an economy. So
Hey Doug, is the debt and GDP slide the one you want to be on right now? Is that
that's where that was before Jane. Yeah, that's.
I just want to make sure I'm on the right slide. So
Yeah, I don't want to sidetrack.
Yeah.
Let's keep going.
I'm going fast, so feel free to interject, because a lot of this is, we got a lot of debt. This is basically showing since 1870, we've had a lot of debt every once in a while. And there is a debt cycle where you've got debt, you got defaults, people don't go into debt as much. So you have the resolution of the debt and then it starts over. Basically, human nature, and this goes to the fourth turning, human nature keeps doing the stuff even though they saw their ancestors do it and it wasn't good for their ancestors, they do it themselves anyway. So this is to represent, there's a lot of debt today. That's basically this point, and it's as a GDP. Go to the next slide. This is another picture of that. This is some people, there's some of these that are more visually interesting than others. This just shows that. Interestingly though, debt amounts seem most frequently occur after different wars. The other thing I noticed, this chart ends in 2015. Some of these, they're old charts, but they show things are running in cycles, which is kind of the theme of this. The next one. Oh, all right. We have geopolitical events. Putin is invading the Ukraine, which is screwing up food and energy for people in the world. These are just different events that have occurred that will cause changes in what's going on in the economy and the world pecking order, the ongoing fight between socialism, communism, and freedom. You've got a financial crisis, the Arab Spring. There are a lot of geopolitical events that are causing changes. Basically, after World War II, Japan and Europe were basically in shambles. They rebuilt. For 40 or 50 years, the world was good. We were the leaders of it. And now everybody's built up. And so our total dominance has become relatively less. And people keep challenging that. And these political events help cause the confusion. Basically, we're going from a calm, everybody kind of agreed with things, to a chaos. These are part of the reasons for it. The 9/11 basically will go on as, we'll call it the war on terror, is what will be a later slide. For entertainment purposes, 1913, we had income taxes passed along with the wonderful central bank's Federal Reserve. And this is basically the tax percentages published by the IRS. And you notice that basically in, early 21, 22, there was a substantial recession, mini depression in 1920, 21. You were transitioning for a war economy to a peace economy, and you had some inflation. So you had a collapse. And what they did, they lowered taxes and got the economy growing again, like in 18 months or so. But this shows one of the reasons why the 20s had a nice roaring stock appreciation. because you had lower taxes. Then they raised taxes. And then people aren't making as much money on their stocks. So they basically don't do as much investing. But these are the capital gains and personal income tax. They're there from a historical perspective. The next one is the corporate tax. Same kind of thing. You really went after the corporations in the, well, I probably with the New Deal. So taxes can cause prices to go up or down, which is really whether people are enthusiastic about investing or not. So taxes are one. Then you got this chart's here. The New Deal, Roosevelt basically took the government, the federal government take on the economy from say approximately 10% or less to 15, 20%. And this chart basically shows, well, it shows it started and then once you got into the war, you've had higher taxes or the 15, 20% range for government take on the total economy. That's what that's there for. Next. Regulations can help. The Jones Act, for instance, is a regulation that kind of hinders growth. Nobody wants to change it. This represents the amount of regulations. You can see from 1993, there wasn't a whole lot to there's a whole lot today. And so typically, if you've got a bottleneck in some economic thing, look at the regulations, and potentially regulations are hindering the growth of what can be done. Velocity of money, this gets interesting. This represents the central bank. This is also the money supply. This is federal central bank activity. It's interesting. The velocity of money today is might be, well, 1.15. It's as low as it's been ever. And you've got a lot of debt, which if you've got, well, say you've got a 1 velocity and you go to 2, if you have, with a 1 velocity, you need a lot of money to maintain the same growth. If you have 2, you could do it with less money. The implication here is we've got a whole lot of money. I'm going to go out later and say a recession is going to be, you're going to have a growth recession or something. This economy has got too much money in it. The problem you've got, if you start to get turnover, people start using money, you potentially may have, you have an additional inflationary problem. But point here is the central banks can influence the economy. This shows the amount of M2 there is, and that's on the left side measurement. And then on the right side measurement is the velocity of it. Central banks have an influence. It's obvious. People are raising hell about it. That's the basic point on that. Same interest rates. They're raising interest rates, which is going to force evaluations down on all asset values, going stocks, bonds, real estate. That's what this is about. Are there any questions so far? Any in the chat room?
No. Yeah, thanks for pausing there. I'm checking. And I'm not seeing anything in chat. No one's got their hands raised, so go ahead and continue.
Basically, we're covering October. We're getting to the end of October. The point of this chart is from a population and energy use. This is energy in general, or electricity. we could have a decelerating population growth, but in a technological society, especially like with Bitcoin, which has had a comeuppance a bit, technology requires a lot more energy. And so even if there are fewer people, there's still going to be an ever increasing amount of energy needed for people. This gets into the energy question. That's the point. This is more of a historical thing. I had a chart from 1200 prices of whale oil. They did get inflationary every other century. Point here is the renewables. And it's interesting that wood was the dominant thing. And what you see with this chart is kind of an industrial age. Once you've got economies grow on cheap energy, oil was cheap energy, and we've grown. And the other point is there are a number of energy sources here, and that's what needs to be. You just can't kill one source of energy. You need them all. The other curiosity point on the next couple of charts is you look at down on the bottom, you've got other renewables in wood, which is minuscule. And that's in probably 2005 or 10. So that's giving you a history of energy. Go to the next slide. We'll go on the right chart. You can see renewables in 2035 are estimated to be 12–15% of the primary sources of fuel. You've got oil, coal, natural gas representing still well over half, 60% of the energy supply source. So people that are pushing to get rid of fossil fuels, if they push too hard, are just plain going to shut down the economy. And that's the point. We need them all. Potentially, you can clean them up. But energy is going to be a potential source of inflation. The other theme in this thing is conclude inflation is kind of here for a while. So that's the energy. Don't need to get into arguments on it. We need any source we have. So next. Oh, this was some people like pretty pictures. This goes to 1800. You go to 1859 with the first oil well, 1930, where you've got, apparently that's where you got into coal-powered plants. We've come a long way in the last 100 years. And that's just basically a visual of it. So next. We're down to investor psychology. And this is a simple way of introducing it. I would have to say this market is still euphoria. They're anxious about the Fed, but they're still not too concerned about a recession, at least by the actions of the market. That's kind of a fun thing. The next one. This is the same thing, but what I had here is, now go back.
Yes. Sorry.
This is a chart formation thing on the right side where you see the cup. When things are really, if they're sold off, what you want to do is buy on what's I'll call the right side of the saucer, which you can see on the right side of the fear or the sell, between the sell and depression. You've got this long period of time where that particular stock or market was dormant. And then it starts to move up on the right side of the, what I'll call the saucer, and then it goes up. The tops are the same kind of thing. When you have a top that is an upside down saucer, basically you've got distribution. And that's just there as a chart. If you can find a thing like a saucer going sideways for a while, anybody who wanted to get rid of it's gotten rid of it, and then they start to accumulate it. That's what that's for.
It's a good slide, Doug. I'll go on the next one.
Yeah. Isn't that a chart of Bitcoin?
Yeah.
It could be. This covers the the manias. We're potentially in the bull trap. So we're potentially on the right side of this thing. So that's okay. Now going into the fourth turning, that Mike talked about is basically you've got these changes. You don't know how they're going to turn out. Most people say, oh my God, it's going to be like the Depression. The market's going to go to hell and the world's coming to an end. That isn't necessarily true. It does mean that you might want to adjust your investment plans. So what these charts are going to be are things that have happened in the past that could foreshadow the next 5 or 10 years, more toward the inflation debt side of it, with those as major factors. They are possibilities. So we'll go with it. Next. Well, this is inflation, deflation over the last 300 years. Until about 1940, you've pretty well had up and down for inflation, deflation. And really since 1940, you haven't seen any deflation. So you just think at some point, you're also getting a parabolic curve on this inflation. When you've got a parabolic curve, they tend to go down a lot on their right side. So this is just a perspective. Also coincides with the different wars that have gone over in Europe and here. So it's just there as a measurement. This is a measurement. This goes back to 1908. Again, John Templeton said, if you have a war, you don't necessarily sell on the war because the war still has products to be sold. What you've got is in this 1973 oil shock or the Vietnam War. That era was when we had inflation, and from 1965 until really 1982, the market was below 1,050 for what, almost 17 years. So 1,050 was kind of the top, and 577 was the low. That's the picture we're going to look at a bit. You also, well, wait, you've got the war on terror, which wars are really not the best use of money. So you get times where you've got this up and down channel thing like we had in the war, which we're going to go to that, go to the next slide. This is another chart of history. Which was a junk call. Sorry about that. This was historical perspective, again, showing that 1,000 mark. But what was interesting, they had it was a 240-month chart. or which is the blue line. So just for the heck of it, I did, where would that be today? At 240, I went to stock charts and did it, put in 240 marks, and it stopped at the blue line was at 1850, or 1805.60. That's where it was in March of 20. March was between 18 and 20,000. The 21-month moving average was 33,641 on the Dow. That's about where it is, or 100 points less than that. I found that curious. It's just a where are we now kind of thing, measurements. So that's a long-term chart again. Next. This is 1963 to 1982, probably. Well, 1980 it says there. And you can see up and down, went to 1,000, went to 700, goes to 1,000, goes to 700, up to 1,050, then goes down to whatever, 577, goes back up to 1,000, goes back down. That's what happened in the oil embargo of the 70s, the inflation of the 70s. 1980, 82 was the era of Paul Volcker, 20% interest rates, and that's when the peak of the interest rate cycle happened. This was what happened before that. So what this do is, and I guess the point I'll get down here is your investment plan set for this kind of stuff? And or if it is, are you emotionally set up for this kind of gyration? So this was inflation's, this would be the inflationary example. And to go on to the next. This is that same time frame, and this one had the number of years. I guess you would call, maybe these flat things are called bear market, secular bear markets. So if we have that, you might need to adjust your strategies or attitudes a bit. Next one is basically the 20s. Well, it starts out in 23, and you can see how the market recovered from the mini depression in 2021, caught on with electricity and cars, and they had 90% margin debt. So you had the roaring 20s. And then you may have had a bank over in Austria go bankrupt, which screwed up the financial system around the world that caused part of this. If you go back to the tax thing, they raised taxes in 29 or 30 to an outrageous amount. But this is a formation that happens. This potentially goes to, we'll get into charts again. You've got a big drop. Well, you've got a parabolic curve essentially in 1929, which corrects as it did 80% on the downside. But then you go to recovering up to the 50% line. And does it go above the 50%? Now, in 2020, March and April, it went to hell, tested a 50% recovery line, and proceeded to go through it, and the rest is history. We've had good growth. This time, the market, they go up, test the 50%, and went sideways again. So you go to the next chart. This is Japan from 1984 until 2014. We have the rise, the parabolic curve. Basically, the emperor's palace was worth more than the state of California in 1989. So you had some over-evaluations in Japan, and it corrected. Now, in Japan's case, it naturally corrected. Japan has been different than the rest of the world in the sense that they have kept their interest rates low, and they do that for exporting. And this chart is different than the rest of the world. And they have a lot of debt. They don't have inflation at this point, but you have basically a period of, I guess, correcting excesses. Excesses need to correct. The government is somewhat preventing them from correcting. And this is an example of what you get with bad government policies. That's all. That's what it is. It was interesting it compared to the 20s. This chart, I didn't really know what it is. I suspect it's Fibonacci, or not Fibonacci, but Elliott wave theory, which Mike's going to get into. I'm looking at a number, well, on the right side of the page, you've got Roman numeral 3, 4, and 5. You go down there and you're looking at 2029, 2035. I don't know if Mike's going to get into that or not, but this is just a chart formation. What it does show is a trend channel. And I had shown another chart somewhere else that basically we have been above the trend channel. So it needs to go down some. How much, you don't know yet. That depends upon policies. So this is just a chart, another chart of saying things are likely to be changing, which is a basic point. This is just another history chart that gives you numbers. It only goes up to 2014, goes back to 1884. So the other thing is the same kind of thing. Oh, that last one's a Dow. This is a Standard & Poor's 500. They're just there for reference. Next. This is passive investing, the history of it. And on the right side, you see it going up to 35%. And this was back in 2010. I don't know what indexing is today, but I suspect it's probably well over 35%. If you're playing the index based on what kind of looks to be coming, I think you got a problem. This chart, again, is just history. Summing up all that stuff, here's a simple way or beginning way to rethink your portfolio. You increase your cash, short-term bond positions, CDs, whatever, reminding you that hold stuff until they mature and the funds don't have a maturity date. Buying precious metals, stocks, which can be gold stocks. Silver stocks is a coward's way to play it because silver will follow gold, but you also need silver for industrial purposes. So do you have any gold, precious metals? And that's more of a currency thing than the actual energy plays that are going on. Real estate's a good inflation hedge, has been, as long as it isn't too debt ridden. So go to the next slide. That may be it.
Yep.
It's not, but my voice is. All right, this is was going to be this month. Next month is going to be the ending part of this. This gets into different wave cycles, which causes the thing. Got the Kondratiev. There's different cycles that Joseph Schumpeter, who is a creative destruction guy, these are ones that he acknowledged. These are going on in the economy. Kondratiev is an innovation thing. Presidential is obviously going to be presidential cycle. So you go on, go the next one. Again, the point is markets don't always go up. Sometimes they take a pause, and sometimes that pause is longer than you want to have, depending upon your own personal position. Next. These are the cycles. These are kind of the ideas of what goes on in those cycles. What they are is, well, we're not going to cover them fast. We're going to cover them fast. Go on to the next one. This is an 18 cycle. This is kind of an infrastructure kind of thing. I've basically, I forgot what these things were. They are a cycle. You had infrastructure, you have innovation, which is Kondratiev. You've got real estate. You have a 7 to 14 year cycle with real estate. This could be infrastructure stuff. Go on to the next. This is real estate. These cycles are out there. They go in a different way or different time frames, and every once in a while they collide into each other, which causes the problems that we might be seeing today. Government policy can accelerate or decelerate the time frame. So we've kind of got the mess. The underlying theme is basically government policy around the world screwed up a lot of stuff right now. Next. This is basically Kondratiev. Going back to the Stone Age, Kondratiev is innovation, and it shows once you've got different ingredients like water and steam and electric, you go on, you use them to go on to the next stuff, and you're going into communications, which we've been in, and we're going on into the information age. So that's a progression, which is, we'll get into that next month. Next. Same thing. This kind of gives the ideas of what they are. You go to the next. Same thing, better defined. Different people provide charts that are more clear. Interesting, they keep putting wars as the change of time. We're into the, I guess, well, go on to the next. Is more environment and, well, biological. We will be covering that more next month. The next charts are, they're there because this is a sixth wave. These are the things that would influence. So you've got a new and innovative stuff coming, which kind of changes, well, like people's work skills. They're outdate a lot of work skills. And so that's where you've got changes. The next two are just kind of thrown in free. Oh, this one is your investment chart. These are industries that are likely to be good. It's a market cycle. Throw that into the pot of stuff to consider. Markets tend to lead the economy, the economic stuff. And so the economy is changing. You get some unknown acceleration sometimes with Mr. Putin screwing up energy and food. And those are the cycles. That's kind of the stuff that makes up why things change and why you have different evaluations of the same thing, where you can have a stock growing 15% that might grow it, have a PE of 30 1 year and 10 the next chart. That was for stargazers. That had time frames to think about. We just go on from there. If you want the chart set, email me. They're available. That's what you would get. Here we've got the market review, which is the traditional stuff, and we can go to Mike now.
All righty. I'll stop presenting. And then Mike, you can take the control and move it forward. Thank you, sir.
Okay, good morning. Slide showing okay?
I can see it.
Okay, great. Well, good morning, everyone. My name is Mike Sullivan, and appreciate everybody spending some time this morning. This is a return visit for me. I think this is my fourth visit to AAII, and I was first here a year or so before COVID, and then I made a return appearance couple 3 quarters into COVID, and then I was here last February. So I've got an update on some of the last February information. So there we go. So the cycles that Doug is talking about are right in line with what we're doing, and we take a macro view of the marketplace and also overlay some of the socioeconomic stuff. Doug showed a chart on Elliott wave, and socioeconomics is a feature that Prechter uses from his Elliott wave group. I've got a chart for them here. And so anyway, the big cycle for us is the monetary cycle, right? So every single chart that you saw that Doug put up there had a data point on it, and the data points are lined up. They give us nice lines. Those are all prices, and they're all measured in monetary units. So what we have is we live within a certain time frame, and so people lose context at what money is in the first place. Less so in this group here, a very informed group that stays up on all this stuff. But when you talk to the broader public, they have no idea. Really, it's just a topic that gets them through day to day, and they take it for granted. So I think our first visit was on the history of money, and we went all the way back from the beginning. What is it? What's it utility? What's the evolution of it? And we overlay the monetary cycle with the market cycle. So the reason that I'm here today is Doug asked me to pop in here and cheer everybody up, right? So I'm not sure that's the answer, but he asked me to cover the fourth turning, and that's something that you could talk about for hours. So what I wanted to do is just cover it at a high level and know that it weaves through the rest of the stuff that we're talking about. Those charts of where we are in the markets, and are we at euphoria? Are we in anxiety? Are we in denial? Or do we have a long way to go before we get to that saucer? That overlays with societal cycles and monetary cycles. And the fourth turning is a book about generation. So a turning is really just a generation that's moving. And Bill Strauss and Neil Howe wrote it years ago, and Bill Strauss is not with us anymore, but Neil Howe does some really good interviews. You can find some stuff out on YouTube and Rumble that give you some plain English. The book itself is very academic, but what it does is it tries to overlay the different generations and how they go through periods of time in different countries. And our own fourth turning goes all the way back to really after World War II. But the fourth turning of that cycle was preceded by the Great Depression. There's always a crisis that turns you from a certain structure in society to the next chapter. And usually you have that creative destruction that comes to play. So there's the picture, of the Great Depression era, and I'm sure we all have family members that we've been fond of, maybe no longer with us, that grew up in that era. And there was a very big distrust of banks. The old put your money in the mattress, put it in a coffee can, bury it in the backyard. Arose out of that. It was a collapse in trust, justifiably, in institutions. So that's where we began in the 4 generational cycles. When you add the 4 cycles together, they're referred to as a seculum, and a seculum just means one long human life. So each of us goes through these 4 phases, turnings, And we go through childhood, then we go through young adulthood, and then we go through midlife, and then we move into the elder phase, and then we're gone. And so this fourth turning is ongoing right now, and you can see the picture down below kind of signifies where we are today. There's next to no context in the American populace about money. It's all taken for granted, and you know that's the younger generation, of course. Everybody's looking at their phones, and I'm sure you see they go out to dinner together, and they just whip their monetary units through their app, Venmo them to each other to pay the tab. But the key full cycles in our history, in the United States history, are listed at the bottom. And so we had the 1760s that turned with the American Revolution. So you had a war, and then we moved along from the American Revolution. Then we had another war, the Civil War, and then our next turning ended again in World War VI. So that's generally said to have begun at the closure of World War II. So you're looking at 1946-ish, and so we've gone through 4 generations of people, families in that time period, and we're in the 4th turning now. And the question is, what's the crisis, and how does it affect us? And it's just a market chart, or is it real? And everybody on this call is in the markets and trying to figure out what to do. So I've got some other context on that I'm going to walk through. Yeah, I've got about 20 slides here. Like I said, it's a long topic, but I want to go ahead and move through it. So if you sum up today, there's a lot of cognitive dissonance around, right? We hear how great things are, and the economy's growing, and you know everybody's happy, and so on. And then you look around and you can see stress levels are off the chart. So we have this big dissonance between how it is, how we think it should be, and if it should continue, and the stage that we're actually in. And that's normal in 4th turnings. And I put a note out in the chat. I don't know if everybody saw it, but Doug had one of the charts up, and you could see the price chart just move in an upward trajectory up and to the right. And that sprang straight out of World War II, right? So most of the planet was devastated. We had the manufacturing base here, and along came the strength of the middle class in the US. And things feel pretty good if you're in the right place on the pyramid. So when you look at the global pyramid of wealth, this was from 2020, you can see the top 1% of the planet controls a good portion of the wealth. And the next phase, people with 100 grand to $1 million across the entire planet, between the two, they control, they're 12% of the population, and they have 85% of the wealth. So a lot of investors, perhaps most of the people on this call, find themselves okay at the top of the pyramid, and we're trying to figure out, okay, well, what are we going to do with our bucket of wealth? And is it, where are we in the market cycle? Can we make it bigger? But by and large, when you start going down the pyramid, life's a lot more difficult for the population that doesn't have assets. So we're in a very inflationary environment. Everybody knows that. This is the Elliott chart, and you can see the date on the top left was January 4th. So Elliott calls us in the grand super cycle, and the grand super cycle says the right side of the chart gets really messy, not just a little bit, but a lot messy. And you'll notice the 5 arrows or 5 numbers all the time. And all they do is say you get trends, and they move in sequences, and the dominant trend moves in 5 waves. And so if I just take the middle of this graph, you can see wave 3 here before that period that Doug showed us, the secular bear market through the 60s and Vietnam and all that. And that ended right there. And that was in 1987. And so we moved from wave 4 up to wave 5. And you can see there's 2 5s, right? One's the super cycle, Roman numeral 5 in the parentheses, and then you've got a shorter term underneath it. But the shorter term takes us from that secular bear market in the 60s all the way up through the end of 2021. And everybody is trying to figure out, well, how do I get back to my statement balance from 12/31/2021 21, but we need to step broader and take the the broad context, because we're also in that monetary system, and you can see the trajectory. It just went straight up. Significance in 1987 was the crash of 87. That was Greenspan coming in, and that was the beginning of your bailout boom bust cycle. And we've had nothing but that since. This is a chart of the money supply in COVID. So nothing that you guys don't know. This came from Shadow Stats. I'm sure people are familiar, John Williams. But we just printed money off the charts, absolutely off the reservation. And that shows up in all of the market charts, including the one that we just looked at. And that is the basis for the inflation that they're trying to dial back. And the socioeconomic stuff says through the cycles and through the fourth turnings, why does everything fall apart? Well, in 4 turnings, 4 generations, the people that lived through the crisis before are largely gone. So they're not able to join in and really share the wisdom of what they went through and what they learned along the way. And so you have another pyramid. We looked at the wealth pyramid, and this was 1911. This is the industrial worker pyramid, and they're taking a shot at capitalism. So they put the money, of course, at the top. But in reality, it doesn't have to be capitalism. It could be communism, socialism, you name it. You have the same structure. And in that pyramid at the top, you have the power center. It could be a prime minister. It could be a king or a queen. It could be a president. And then underneath, we have a religious impact that influences people and makes them make societal decisions along the way. Then we've got the military, and then the next tier is the bourgeoisie, right? And we eat for you. And by and large, most of the people down in that global wealth pyramid are the ones that are doing all the work, and they're getting blistered right now. They don't have asset portfolios. So when they walk through the grocery store, or they get their health insurance bill or their college bill, or stop at the gas pump, they're just getting crushed. So the central bank has to back all that off, and that's what that policy is. But as you go through 4 turnings, you get more and more corruption up at the top of the pyramid, and you see a lot of 2 skill sets that take people to the top, and they're skilled at lying and they're skilled at exploiting people, perfectly comfortable doing that. And not everyone by any means, but a lot of them. And so the money that's printed is rewarded to the people at the top of the pyramid, and it rewards the exertion of both power and control at the lower ends of the spectrum. And if you look at sociopathy and psychopathy, that's 3 to 4% of the population, and that's what you get a lot of at the top. And we live in a planet of half truths, and our job is to try to interpret the math from a monetary standpoint and determine how to place it from an investment standpoint. This chart shows you the Fed balance sheet, the green line up at the top, and that's just barely rolled over. So we know what the debt is. It's exploded. The off the books debt is staggering. But the Fed's balance sheet just by itself had risen 115%. We saw a huge spike in commodities. It's energy that's carrying the market this year. Some of that's geopolitical, and some of it's just cycle. Corporate profits are doing great, right? They're up 50% over the last 2 years. Home prices jumped up 42%, and wages, even though they finally got a bump over those 2 years, it was really just to try to keep up with the pace on the rest of the stuff, and it's failing. So that's your basis for your cognitive dissonance. And this chart I brought in February. So when I was on this call, I pointed out this is just a valuation chart, right? So this takes, on the left-hand side here, you can see this axis. It's the S&P Industrials price, the price of the S&P Industrials divided by their book value. And the bottom of the chart shows the dividend yield of the S&P 500, not the industrials, but the whole S&P 500. And it's inverted. So the right-hand side of the chart is 1%, and the left-hand chart is all the way up to 16. And I'll go through this here, but the key points on this chart is this is where we were at the end of 2021. And we had pulled back a little when I visited last time. And I said, I know everybody wants me to tell them that stocks are going up, but I want you to look at the valuation and just ask yourself, what are the odds that stocks are going up? And we kind of, the rest of 22 so far has given us the answer to that. When I break this down, this is just a zoom in to the bottom of the chart, and you can see, zooming in, you can see that the box at the bottom here is concentrated. We see our dividend yield with the red circle on the right at 1%, and the current yield, the current dividend on the S&P 500 is in the mid ones. It's still 1.5. But if we look at it versus history, and we notice the box, we see the right side of the box, again inverted, was 3% to 7%. So dividend yields historically, and in particular in that highlighted area, since 1927 until 1988. So remember, Greenspan showed up in 87 on that Elliott chart and the boom bust bailout cycle. But until that, Greenspan showed up, this was our dividend yield. Normal was 3 to 7%. That's what you would expect to get in that range. And outside of this box, actually on the left-hand side, you could see the valuation, what you were willing to pay for a company, a stock of a company, was about 1.25 times its book value. And it's almost all after Greenspan, where we just launched straight up to the right and to the right. And the outlier, the big outlier, red circled up there, was 1929. And everything else, that's the adult life of almost everybody on this call. This is what we're used to. That's our recency bias. And we have to take that into account when we overlay that with a fourth turning cycle. So if I zoom back out on that chart, and you can see up top, there's your dividend yield over to the right because it's inverted. So the dividend yield was about 1.6. And the multiple times book value of the S&P 100 or the S&P industrials was 7. It was 7, not 1.25 where it was before Greenspan, but 7. And this is where we are at the end of the third quarter. So as difficult as 2022 has been, you can see we're still pretty lofty from a valuation standpoint. And so we want to take that into context. Doug showed some slides on, he mentioned Volcker. He showed some slides about the 70s and OPEC and that difficult period in Vietnam. And you'll notice on the left hand where that star just bounced in, well, this is Vietnam. Right? So that the interest rates were moving up, the red line's the 30-year treasury, and they were moving up because of all the expenses. We were essentially bankrupting the US through Vietnam. And so Nixon closed the gold window, and then things got really out of control because now we're fiat. And so Volcker had to step in, and 30-year treasury was up over 14%. And we got into full fiat manipulation. And you can see this label here, the middle class disintegration. On the left-hand side, a lot of you will remember, dad worked, mom stayed home, 3 or 4 kids playing in the yard, a single income could carry the household, and life was pretty good. America was the manufacturing base for the world for a long time. But what happened through all of this period of time with all of the money printing is it got a little bit harder. You ended up with 2-income families, and things deteriorated to a degree. So that's the arrival of Greenspan right there. And you can see the boom bailout cycle has repressed interest rates, and it's totally necessary to have rates drop. They're doing the opposite right now. This blue star is the repeal of Glass-Steagall, right? So they undid the protections from 1933, which kept Wall Street out of commercial banking, and they let the fox right in the hen house again. And that's what they did, boom, bust, bailout. And so now you've got two income families working, inflation's high. And what Powell's doing is they keep reciting Volcker. Look at the rates, right? The balance sheet was so much healthier back then, and there was room to do that. And then look at the incline with the rates that have been taken this year. And that's troubling. That comes straight into a fourth turning type of cycle. So, and then that's your your Great Recession, right? 2008, 2009. But again, that was on the backs of the boom bust bailout cycle. And we've done nothing but print money since then. So we're seeing that show up. Doug talked about bonds but bond ladders seem to make some sense. So this is from Bloomberg, and this was on November 14th. And you can see a three-month treasury right now. Go buy a 3-month treasury bill and you're getting over 4%. And if you look at 12 months, just 1 year, it was 4.6% in the middle of November, just the beginning of this past week. And here's the kicker: is the 10-year is only 3.9. These have not changed much coming into this morning or the close of the markets yesterday, but that is your inverted yield curve. So if you plot it on a graph, right, it's going up into the 1 year and the 2 year, and then you're dropping as you get out to the 10-year. And I'm sure everyone here is aware, but that simply means Fed's going to do it. They're going to raise rates. They've told us that. They're raising rates. They're trying to knock asset prices down. So we're talking about stocks and what do we do? And everything they've done is said we got to knock prices down. House prices, car prices, stock prices, the groceries in the on the shelf at the supermarket. So that's where we are. And this is a chart that I showed in February, and this was the end going into the end of 2021. And these were the indexes, and you could see the indexes rising all the way up into the year end. And this is the NASDAQ in the middle box, and you can see that arrow right there that represents the peak. That peak is exactly where the Fed stopped printing money. They printed 120 billion a month every month last year, and they dialed it down by 15 billion a month starting in November. As soon as they dialed it down, everything started to roll over. And then this is the NASDAQ composite here. And, this is taken out into 2022. But you can see if you look at this, the chart is with the blue candles, but underneath is the advanced decline line. And you can see underneath the index that there was solid selling off of many stocks. It was hidden by the mega caps, the Fang Man stocks, but underneath, the folks that know they're going to remove money and raise interest rates were selling. And you can see that trajectory right there started well before the markets peaked out. And there's a good possibility that that's what's happening right there. So the left side of this upper arrow that just flew in, that's when the Fed stopped printing money, and you had one more head fake and into year end, and that was over. And you can see the market sold off a little bit, but it came right back to the right side of the arrow, and that's the place everybody wants to get back to. And the question is, can we? So Doug talked about price earnings ratio. That's a big metric. So this is a leading tech stock, and what you can see is that the price earnings ratio last week was at 25. And if I go back to the fourth quarter of 2018, when the monetary system first kind of told us it was failing, and I go to COVID, the price earnings ratio was down at 12 and 13. So right now it's at 25 times the forecast earnings. But if you drop it back, drop that formula down on this stock or the market as a whole, everybody's trying to figure out, hey, I turn on CNBC and they say, hey, the Fed's going to pivot, everything's going to be great, and we're off to the races again. If the earnings decline just 15% and the PE contracts to 15, there's another 45% of downside in this stock and all the rest. So that's something to take into consideration. And so we have all of this in the backdrop. The Fed's removing money, they're extracting 90 billion a month from circulation, while simultaneously they raise rates. So that's a pretty big headwind for the narratives that we hear on CNBC. And I think we see some of the selling underneath that we presented back in February. So the big game and the thing that could toss a fourth turning type of event could be the not just a war, though we have that going on around the world over in Ukraine and Russia, but It could be a currency event. It could be a financial market collapse if the monetary system doesn't hold up, and that's totally dependent on confidence. So we are the reserve currency. I've presented this slide before. I know I'm going kind of fast here, but this overlays with the fourth turning too. And you can see all of these countries that had the privilege of being the reserve currency in the past, and their timeframes are generally the same when you look at the box. And if we extend that box, because this was a 2012 slide from Jeff Gundlach's presentation, then the rectangle starts to look awful similar in time and distance to the predecessors to the dollar as the reserve currency. And if we take 2023, I rounded us up to the end of the year, and say this fourth turning began in 1946, well, we're 77 years in. And some people like to take it all the way back to 1929, though Strauss and Howe used 46. So that's 94. So we're long in the tooth of this cycle. And so you have to look at what's going on with the reserve currency, what's going on around the world. And the big 1, 2, 3 is your money has to be trusted. And the country that holds the reserve currency has to deficit spend. You have to support the rest of the world, basically, while you have the honor of having the reserve currency. And ultimately, you overdo it, and then the reserve country weakens, which is not happening right now yet with the dollar. The dollar is very strong. So this is the rest of the detail. You know, the money is originally trusted. Once they destroy it, it gets connected to a real asset, and that was gold originally. Doug mentioned that. And when we disconnected from gold, we connected to oil, and then disconnected from oil, and it's been fiat since the early 70s. So real money moves to the productive sectors, and as long as you're okay in that monetary cycle, things hold up. But once you start overdoing it, that's where you start to lose confidence. So certainly the U.S. has consumed, and we've done our part, right? We shipped all our manufacturing overseas, and then we buy manufactured goods from overseas, from foreigners. Foreigners accumulate the reserve dollars. That's going in reverse right now. And year to date, there's been, I think it's like 480 billion in U.S. treasuries have been dumped. They've been accumulated all the way through this cycle. But just in September, China and Japan alone dumped 118 billion in U.S. treasuries. So there's stuff going on that is more than geopolitical, it's monetary. And you have a currency war going on right here, right now, and that should come into consideration. And for example, the BRICS, everybody's aware of the BRICS on this call. And in comparison, the G7 GDP is around $35 trillion a year. So that's the old guard, right? And at 35 trillion. Well, if we look at the BRICS, if we look at this original core lineup, they're near 30 trillion, most of that in China. Over 2/3 of that is China, who's struggling a little bit this year. But we also know that the BRICS have approached Argentina, and they've approached Iran. And we know that Xi got on the plane and flew over to Saudi Arabia and was talking with Saudi Arabia. So Saudi Arabia is, that's who Kissinger brokered the petrodollar with when we closed the gold window. And so that's a big one. You lose Saudi Arabia and everything changes. And that strong dollar does a reverse. And we find out if that's what a lot of currencies have done before they have trouble. It's kind of like a blow off top in market terms. So we see increasing controls being put on money. And this is an article that shows you some of the restrictions. This is from HSBC, that the money in your bank, it's actually, hey, you loaned it to the bank, right? So it's theirs now. They have a liability to you, but it's theirs. They've changed the laws in different countries, and you can see right now, and with what's going on with energy and inflation in Europe, Germany, they're talking about restricting people's access to their banks. They were talking about restricting Italians' access to the euro, because they wouldn't bring in some of the boats off of the Mediterranean. And so you have all kinds of currency wars going on. And you had a big one due to Ukraine when Biden kicked Putin off of the SWIFT system. He kicked Russia out of the SWIFT system. He kicked he kicked a major oil producer out of the global financial transaction clearing system. So Putin turned right around, and now he sells sells Russian oil in ruble. So that weakens the petrodollar. You wouldn't know that. And then this is just this week. We can see, we saw all the stuff with FTX, and now we see the central banks, right? So they kicked the leg out on crypto. And so never let a good crisis go to waste. Only trustworthy people like the global banking cabal should be in charge of putting all of your money in under their digital monitor system. So that's real stuff. It is fourth turning. It lines straight up with what's going on with the fourth turning in a potential crisis, which historically, again, has been a real war or a financial problem. And it lines up with Elliott too. So I know that's not the most cheery thing, and I know Doug's got more stuff to talk about, but I'm happy to be here in the Q&A session when Doug wraps up. And I can give it back to you, Dave or Doug.
Yep. Thank you, Mike. Appreciate it. So I think what we're going to do is, Doug, you're still on. Why don't we,
Are there any questions for him right now?
yeah, let's do that. So any questions right now? I there was some Q&A or messages about chat being disabled. I believe I got that fixed. So let's just give folks an opportunity to, if you have a question, go ahead and put it in the chat box. Everybody, that should all be enabled now, so everyone on the call can enter. Let's go and look. James, did you have a?
Yeah, I had a question for Mike. If you think the US dollar is nearing the end of its status as the world's reserve currency, what do you see replacing it? I mean, the Chinese renminbi or a basket of currencies, or what?
Yeah, I would, of course, I don't get invited to that conversation, but you still have economic activity in every country dependent on that, and you're probably looking at like the strategic drawing rights. Jim Rickards, you may be familiar with, has some good information on that, and it would be a basket of currency, and the dollar would potentially have a smaller role than we have in the past.
Okay.
Mike, there's a couple of questions here. I'll just put them to you as a collection. The first question has to do with, could you give us kind of a net answer on what caused the fall of the middle class? And that's the first question. And then the second question's more about just getting a conceptual summary of what fourth turning is. I mean, the example was, are you saying this is fourth turning is total chaos? Summarize it a little bit.
It can be, and it's, again, the book's pretty academic, but there's some good resources. So, there's, like I said, good interviews with Neil Howe out there, where he speaks in very plain English. There's a website, just fourthturning.com, where you can go read up on it. And there's different personalities. So each personality comes through their generation. Like we bracket people by eras, by years, but it's more the collective personality of who they are. And I know everyone can relate to this if you have kids, because everyone here was a kid, right? So like the last ones you follow directly are your parents and their generation, right? You see the world different. You're a little bit smarter by the time you go off to college or get out of high school, and you know everything. And so you tend to be different. So the first and third generations, you tend to be more perhaps like your grandparents were, and your children can fall more in line with your parents, but they take on different personas too. And the terms they use are hero, artist, prophet, and nomad are the four categories. But a turning itself is just the generation that class marches through. And if you take it back to obviously 1946, which I'll go with Howe because they wrote the book on it. They have all kinds of data in the book, very academic. But if you take it back to then, it's somewhere in this neighborhood. It is an unpleasant event, I'll say that. So it could be a financial crash, it could be a war. And but that's where I would overlay that with the monetary system. And we're math guys, and a lot of the stuff that we see, the nonsense that goes on in the marketplace, the manipulations. You saw the stuff with the crypto over the last week. I mean, you saw stuff in 2007, 2008. That was the biggest boom and bust, which is less than a decade after Wall Street got to storm into commercial banking. And so we had a big beatdown, and the solution to the too big to fail banks who had too much debt was, guess what? More money printing and more debt. So you reach a point where you're past mathematical sustainability, and you could take the off the books obligations with Medicare and Social Security and all that and add it on to the published national debt, which is over 30 trillion. And you could just say, hey, this doesn't work anymore. If you go back to Triffin, it takes people to lose faith in the currency. And that's where the Fed is right now. All right. They printed so much money, and we loved it when it popped our asset values up. The key was whether anyone banked it or not. And if I do straight math today, and go back to the chart that Doug shared with the, perhaps a bull trap, right? If you're in a secular bear market, that's exactly what this is. And you can line up a lot of observable events aside from the charts that would make the case. But if you just do straight math, there's three components of an interest rate. When you invest in a bond, it's supposed to give you a real rate of return, and then it's supposed to cover inflation and taxes, and those three things. And in a healthy economy, the yield on the bond is going to cover those. Inflation, a real return for you. Hey, 1%'s okay if you could stay ahead of inflation and cover your taxes, right? So we got this big rally because inflation dropped from over 8% to 7.7. And so the market's celebrating that. And the market is using the term pivot. We hear pivot, pivot, pivot. And when we follow math, then we have to match it up with words. That's the most challenging part of our job, aside from trying to communicate this to the broader public and our client base, that's an untruth, right? So we saw in 2022 the definition from recession revised by the administration, by the head of the Treasury, former fellow. Yeah, we're not in recession. Well, you got 2 consecutive quarters of negative growth. That used to be the definition. So they changed the words. They've changed the word of pivot. And pivot was when the Fed reduced interest rates. They reduced them. And so what we got was, hey, maybe they're not going to raise them by 0.75% in December. Maybe they'll only raise them by 0.5%. And then you hear all the, talking heads in the financial media, hey, that's a pivot. It's not a pivot. It's not a pivot. It's a reduced hike. You're still putting on the brakes. You're just doing it a little less hard. And so if we go back to the inflation at 7.7 and go straight to the 10-year Treasury, 10-year Treasury is paying you 3.8%. Now subtract inflation at 7.7 and at 3.8 on the Treasury, give yourself a 20% tax rate on that. So you got to throw in another, 0.8 in taxes. So 3.8 minus 7.7 minus 0.8 is you're losing value right now. And so that's the bind that the Fed is in, and they're not being honest about it. And that's nothing surprising. But all of that money printing has taken us very late in the stage. And so we're cautious about that. And I don't disagree with Doug that it could very well be a bull trap. And I could take the economic announcements. If we turn off CNBC and we say, hey, what just happened? And we look at the jobs out there. FedEx just furloughed a bunch of drivers, right? That happens next week, I think. When has FedEx in your adult life laid off drivers going into the holiday season? So that's telling us something. And then you see Amazon and Disney, and so they're trying to raise prices. Disney's raising prices, it's laying off people. So all of those people that are getting laid off, the only way that they're spending into the top line of the companies we're investing in is if there's more stimulus coming, and the CPI is 7.7%. So I think that's where we are in the charts, and that's where we are on the monetary cycle. And the only mathematical way out of it is if they do, I mean, they have to put more dollars in circulation and they have to knock rates down, because that's what their whole system is now dependent on, because of that exponential wave 5 that we looked at that's been going on for 35 years since Greenspan in '87. So the fourth turning is messy, could be a war, could be a financial event. And I know it's not cheery stuff, but that's not my job. My job is to get everybody to consider how much risk they want to take and where they think we are in the cycle.
Yep. And
Um,
so then that one graphic that you showed, that it was a fairly severe descent for the middle class. So
Yeah.
was that if you had to net that out, what was the main cause of that severe looking decline?
Yeah,
General?
good question. And the answer is, remember that red line that was descending like that? That was the 30-year Treasury yield. In the past, I've taken a 10-year Treasury yield, and it does the same thing. It goes from a high value on the top left of the slide, and it goes down and to the right. And you could draw a line from Volcker all the way through here, and you could go through 2018. And I'm sure all of you will remember in the fourth quarter of 2018, as we came into the fourth quarter of 2018, Powell was raising interest rates, and he was not doing quantitative easing. That was dialed down. And Trump was tweeting away, hey, what are you doing? What are you doing? You can't keep raising interest rates. And we went into the fourth quarter and they said, yeah, we're going to keep raising interest rates through the fourth quarter. And then we've got 3 more coming for 2019, 3 more coming. And Wall Street said, no, you don't. And they beat us down in the fourth quarter of 2018 from October 1st. Go pull up a chart of the Dow. And they beat us relentlessly down over 20%. The small caps, where rate borrowing money is more expensive for them because they can't go to the bond market like the bigger companies. And we just got waxed. And they reversed on Christmas Eve of 2018. Mnuchin, the Treasury Secretary, called up the president's working group and said, hey, we need some help here. And he cabled that in. He was vacationing in Cabo with his wife, right? He said, hey, I just talked to the president's working group, otherwise known as the plunge protection team. And that was Christmas Eve. And we lifted our head up into the holidays because everybody's, enjoying the holidays anyway. And on January 4th, 2019, Powell was sitting on stage and he said, yeah, we're not going to do those 3 interest rate hikes, and we're going to turn around and we're going to do QE. And that's what got us this wave 5, at least into COVID. And then we got the COVID beat down and exponential amounts of money. So that right side of that chart was the 30-year Treasury yield, and that is financial repression. So you have to make borrowing money cheaper, and you have to make the money supply grow to be able to support asset prices. Well, you've gotten to the point where you've priced the younger generation, that particular turning, they're priced out of homes. So everybody on this call, you might, depends on your region of the country, but we've enjoyed seeing our home values go up, but they priced them right out of reach of all of our kids. Anybody that has to borrow money can't get them. And I'll give you a example on that in our newsletter. I have an example of somebody buying a $400,000 house at the beginning of the year with the 30-year mortgage at 4%. A $400,000 house alone at 4% would cost $1,900, $1,909. And so a kid could say, hey, I could afford that based on my job, or maybe I'd go in with, I have a roommate pay me rent and I'm going to get that house. And they got $1,900. And then we tracked it through the year when it hit 5%, 6%, 7%. So now it's at 7. And that monthly payment is almost $2,700. So, my daughter's not getting an extra $700 a month in her paycheck. Paychecks don't move like that. So the only other way to do that is exactly what happened in 2008 and 2009. And that's reverse pricing. And if the buyer can only afford $1,909, that $400,000 house has to drop in price all the way to $287,000, 400 to 287. And when you talk to people, we've got this recency bias, and they say, well, that'll never happen. That doesn't happen to real estate. And I say, well, what are you talking about? You just watched it do the opposite. And, in 24 months preceding that, you just watched it go from 287 to 400. So the Fed is doing the opposite. They're making interest cost more and they're removing it from circulation. So that's the risk that they have. But they told us they were going to do that, and they actually started doing it in November of 2021, and nobody believed them. But we could see it being sold underneath the with the advanced decline lines.
Okay. There was also a question. There was a chart about the distrust of banks and essentially the risk of banks confiscating cash. So one of the questions that was posed is it conceivable that, let's say, cash in an IRA could be subject to confiscation? I mean, is it that extreme? I mean, that was one of the questions that was asked.
I don't. That's pretty extreme. I mean, to do something like that, you talk about loss of faith in the currency. I mean, that's like we're in Mad Max world. So
Okay.
I don't think the odds of that are extremely high. But your cash has been confiscated since 2008 or 2009, when inflation was created and the bank was paying you zero on it. So and the inflation data is misrepresented. For it to be physically confiscated would be, that would be global chaos. And all of the banks have FDIC insurance. Remember, in 2008 and 9, they raised the coverage level from 100 grand to 250, specifically to have people not panic their money out of the bank. So I can't say no, but I think the odds are next to that.
It's pretty extreme. So then the other thing is more of a kind of a math question that was posed is, as the Fed continues to intervene to fight inflation,
Yeah.
is there a mathematical way out of this, or is it just where it's an ultimate train wreck that is going to have a period of real chaos?
It's a difficult way out of it, because I mean, just the equation that I said, you got inflation at 7.7 versus, what the taxes you're going to pay on a 3.8% treasury. The Fed, they talk a lot. So that's part of their toolbox. When they say tools in the toolbox, they do their forecasting, and so they'll send Fed presidents out, and one will make a statement, and then if it starts to get chaotic in the marketplace, they'll send out another one, and they'll say something different, say, well, I see it different, and so they kind of manipulate the markets through their word. They're forecasting what their actual policies are going to be. They've been in lockstep, I mean, the whole way through, and I think they knew exactly what they did when they printed all that money out of COVID, and they can sleep at night. They told everybody we're going to raise interest rates, and again, in lockstep. And so what we've seen the most really just last week is we saw a couple of them come out and say, well, I would be okay with 0.5% maybe, in December instead of 3/4. But again, that's not a pivot. That's, you still have your boot on our neck. They're still raising interest rates. And traditionally, before they did all this wild money printing, you would see a lag after the pivot. And you could go back and look at 2001, 2008. They've gone too far, and the valuations got high. Remember the red circle chart. And so then everything has to retract itself and pull back in. And so if you're the Fed and Wall Street, I think they know the only way out for them to stay in the driver's seat as an institution is to get this back under control. And so they have to work the bottom of the pyramid. So what they're doing right now is they're trying to take that bottom of the wealth pyramid, and they're saying we have to knock their groceries down. And unfortunately, that means they've got to hammer businesses, and a lot of people will lose their jobs. So you get into this
vicious circle.
You get into a vicious circle. And so the politicians will want to do the fiscal rescue. And, California just issued stimulus payments to help offset the cost of inflation. So you get into that. That's where the math starts falling apart, and that's where you get into the loss of faith and the Triffin paradox as well. But the bigger thing right now is the geopolitical stuff, and we don't get any coverage on this. I'm sure some of you remember when I was a kid, we used to laugh at Russia and we'd talk about Pravda and Taft and that they publish nonsense and the Russians all believe it. I can't believe it. And the stuff that they publish through our mainstream is nonsense, or it's a half truth, and they don't finish the rest of the story on that. The big issue that we've got, the geopolitical issue, is the BRICS. And when they kicked Russia off of the SWIFT system, that Societe for Worldwide Interbank Financial Transactions, they hammered the Russian people. I mean, the ruble lost like 40% over the weekend, and then it gained it all back. And they said, okay, well, if you want any natural gas in the winter, Europe, you better give us rubles. So that really is something we have not seen in our adult life. And that goes right back to the reserve chart. We take it for granted that our dollars are going to be worth as much. And even if they do a SDR, the strategic drawing rights, and the dollar's part of the basket, then, but at a reduced percentage, then we've got more inflationary problems. We're in the same boat as everyone else.
All right.
And I think that's what they're doing. I think they're raising rates, and you can see all the currency problems and the inflation problems all across the planet. So if you're extended like you are in Japan and Europe and the U.S. by raising rates is actually attracting assets into dollars, and so they could be the last fiat standing. And I think that's what's happening. They're trying to hold on to their place in ultimately what the currency basket is.
All right, makes sense. So let's do this. We're going to transition back to Doug. And before I do that, for you, Mike, just something to ponder before we hit roundtable, because I think it's on. It was asked in chat, and I think it's probably on other people's minds as well. Is if you could maybe formulate some suggestions on the types of investments that people should consider or evaluate as part of a fourth turning. Ponder that and be thinking about that when we come back to roundtable.
Yep.
Doug, if you're ready, I will go ahead and let's hit the current state quickly, so we give people on roundtable enough time to chat, to talk if they want to talk. So let me go to your
market influences.
All right, let me just get to that first, and then we'll hit that quickly, and then we'll pivot. We'll pivot, as he said, a roundtable. How's that? Let me.
You get there, and this currency, reserve currency thing. Saudi Arabia apparently has been selling oil for BRIC currencies to BRIC currency countries. So potentially the reserve currency, there may be two of them, where the United States will no longer be the heavily dominant reserve currency. It'll be one of the reserve currencies, and I'll call it a BRIC currency, is being promoted, and potentially the BRIC countries could be trading in between themselves with their currency, and the rest of the world would be on the dollar. This is the same situation where you're building two different supply chains, and you may end up having a BRIC or China influence, sphere of influence supply chain, and then you've got a US Europe supply chain. So those are things of another change. The weather is another change. Market. All right, go to the next slide.
Yeah, let's see if we can get through this to give plenty of time.
We'll
so roundtable. So everybody knows your
about
flow,
the Federal
right?
Reserve government that
that's the
trying to
mindset
shut
every
things
time
down.
we do this.
Investor psychology is probably, let's call, confused, conflicted.
Yep.
One day they're greedy and the next day they're fearful. The economic cycle is potentially a meandering, muddle rather than a recession, or there are different pockets of the economy that are not refusing to go down and others are going down. And as for more new lows and highs, this week, we had more new highs and lows. We are in potentially just a short-term rally that may end next week. In a longer-term downtrend, it's still there.
Right.
There's a longer-term downtrend. Bullish percent is wildly optimistic. We can just do this, do the overall market. This is a daily chart. You can see it's doing its thing. It's below its 200-day moving average. Go to the weekly part. And we're there. That's all you really need to do. Basically, we're in a pause with a rally and most likely a continuing downtrend of unknown depth. But I also suspect that this is more of a financial problem than a Wall Street problem. So I wouldn't be surprised to see the market go to hell on somebody's bankruptcy rather than just some economic data. So I'm not convinced that people only focusing on economic data are going to be getting the market direction right. It's
Gotcha.
still there, but that kind of summarizes it.
Okay, so we go to roundtable. So I could go ahead and transition it so we give folks an opportunity to speak if they want.
Go for it.
All right, sir. All right, I'll stop sharing. So for those of you that may be new, we do give everyone an opportunity if they want to speak, ask questions, share thoughts. If you do not want to, for me to call on you, I see Alicia is obviously familiar with how we do things. Alicia put something in the comment that she's just listening today. So if you're just listening and you don't want to say anything, just put something in the chat and I won't call on you. If I don't see that, I will give you a verbal opportunity to speak if you want to speak. So this is simple. I go to the top to the bottom. First person on deck, I'm going to unmute is Gary.
Oh, hi, this is Gary. I want to thank Doug and Mike for the wonderful presentations. And other than that, I can't, I'm just trying to digest it all. Thanks.
Which, as an aside, that's what December is going to be about.
Right.
There's a lot of information. And next week, next month, we will, the questions, we can address it next month as well.
Right. So that's actually a great tee up. So for everyone listening today, you may or may not have known, we had a little snafu in October where we actually couldn't do our October presentation. So we packed a lot of information in today between Doug and Mike. So want to just give you an alert that December 10th, we weren't planning on doing something in December for Horse Saturday, but we're going to do that. And it's going to be on the 10th. So look for my reminders that's coming out. They'll come out as reminders through AAII and also through our local email distribution. So it'll be Saturday, December 10th. What that'll do is that'll give you guys a chance to kind of soak all this information in and then come back in a few weeks and, ask questions and you work through all the fogginess that you might have. So Gary, if that's it for you, next up is Mr. James Hapner.
Oh, hello. I'd wondered, I wasn't able to get in October, so I wasn't sure if the meeting had happened without me or not. So I'm glad to know I didn't miss anything.
No, you didn't.
I haven't been very active in the market the last month or so. Opened a bunch of new positions back in July when things were relatively cheap and the market was going up, and it's been up and down since then. I think we've probably seen the lows for the year this year, but I wouldn't be surprised if the market went lower than it is now, into 2023. I agree we're heading towards a recession. When I gave my dinner presentation in October, I mentioned the British government having a sort of the fight between their political branch, the the elected officials and the Bank of England, and they resolved that with the political officials getting the heave ho and the Bank of England continuing to raise rates. So England's forecasting a fairly sharp recession for 2023. I think the rest of the Europe will be in a similar boat, and we'll have something similar here in the U.S., though probably not quite as bad. The elections turned out to be basically a muddle. Very narrow Republican majority in the House. Dems held on to the Senate. Not much change in the state houses around the country. So it looks like 2 years of gridlock. There'll be a lot of investigations of various things by the new House, but I don't think there'll be any significant legislation passed. There may or may not be showdowns over the budget, government shutdowns and default threats and debt ceiling fights and all that stuff. But if there are, I don't think they'll last very long. I think it's mostly be for show. They'll probably just agree to keep the government on autopilot, spending wise, continuing resolutions, which is to say, basically the Democrats' budget from the last couple of years will continue until after the next presidential election. So the economy will struggle. I mean, from the Fed's point of view, unemployment's low enough that they can concentrate on inflation, and I think they're going to raise the Fed rate well beyond 5%. I mean, they're around 4% now. I think there's going to be at least another 150, probably 200 basis points of Fed hikes coming. I don't know if they'll be in 75 basis point increments, but it's going to, Bullard was out this week trying to, sounding pretty hawkish and trying to jawbone things in the line. The last couple of PPI and CPI readings have been, they've been showing some decelerating inflation. They came in a little bit better than expected, but by themselves, they're not enough to slow the Fed down. I mean, with unemployment at 3.7%, there's nothing holding the Fed back from hiking more. The funny part about all that is that hiking interest rates doesn't really take money out of the economy; it just slows the movement of money within the economy. I mean, if they want to take money out of the economy, the way to do that would be tax hikes on the fiscal side rather than the monetary side. But the politicians aren't going to do that. So the politicians are happy to leave fighting inflation to the Fed. So we'll get higher interest rates to only moderate effect, and inflation, I think, will persist for a while. It'll gradually decelerate, but I mean, a year from now, it'll still be probably above 4%. So that's my general outlook.
So James, this is, I think, probably for you, it would be good for you, James and Mike, because this was a question that was posed. What are we hearing about a Fed terminal rate in 2023? Is stop at 5%? Question mark. So would you guys share some thoughts on that?
In my opinion, no, they won't stop there because they generally agree that the nominal rates have to go above the inflation rate. That is to generate a real interest rate, positive real interest rate. And currently we still have negative real interest rates. So given that unemployment is pretty low, I don't see any reason for the Fed to slow down. I think they're going well past 5, maybe probably to 6. I don't know. Mike, what's your view?
Yeah, I think they're going past 5 as well. And Bullard was out, James Bullard. This is an example. Again, they've been in lockstep, and there was a question earlier in the chat room as well about the policy versus the stock market, and they've said they don't care about the stock market. And when we've had rallies in the summer rally, they specifically come out and say no, we're not kidding. We're going to keep going on this rate. They have to get inflation down for the populace at large. And if that means taking the asset prices back down, then they're okay with that. And that's very different than they've done before. So the market's been rising. This goes back to Doug's, thought that perhaps this is a bear market rally or a bull trap. And, when the market's risen, they've come out and talked it down. And in fact, at the last Fed meeting, I was watching the conference, and Chairman Powell came out, and it was one of the conferences where they they issue the statement, and then he comes out a half an hour later and talks questions. And it was on Bloomberg that I was watching, and the host had the same observation that I did, because of course during the press conference when he's talking, he's not watching the markets. And a reporter came out and said the market's rallying, and it was. The market came out. The Fed did exactly what was built in. They raised rates 0.75%, and there was a comment in the minutes from the second in charge, Lael Brainerd, that said, we are mindful of the cumulative impact of the rate hikes. All right. So the rate hikes they've done this year, starting from the low level that they were at, is unprecedented. And that's because the bubble they blew was unprecedented. And so the market was rallying because they took that sentence. This is us, the recency bias. We're used to them making the market go up, and the market was rallying, saying, hey, maybe now they're saying we've done a lot, let's pause. And so it's rallying, and the reporter asked the question and said, Chairman Powell, the market's responding very positively. And he said, let me reiterate. And he listed off like 5 bullets, including we're going to keep going. And I think that 5% is their floor where they're going to go to, and they're going to see where inflation ends up in there before they back off. They have to get it down. Or I think that, the gig is up for them.
All right.
Yeah, I mean, being a Fed official is like being the Treasury Secretary. It's a confidence game. They have to maintain confidence in their ability to, be masters of the universe in effect. And I agree with Mike. They're going to keep going.
Yeah, and they watch how they're managing their heads when the market, they're talking heads when the markets get a little frothy and they look like, hey, we're going to rally back and do what they're talking about on CNBC. They'll send out 2 or 3 of them and then hammer it right back down again. And that's what they did. And Bullard said 5 to 7%. He had a presentation and he had 7% on a slide. And the markets, the players in the market just kind of laughed it off. They're like, they're not really going to do that. And that was not the right answer. So they sent 2 more out the next day to say the same thing.
Yeah, I mean,
we're going to keep going.
Steve Leisman of CNBC is basically practically a spokesman for the Fed.
Yeah, he is. A lot of them are. They don't ask them tough questions.
All right. Well, thank you both on that. I am now going to go. I see Bob Barker has got his hand raised. So Bob, I'm putting you in the room to talk. I believe you want to share something, Bob Barker.
Sorry, that was a mistake. Please proceed.
Oh, okay. Great. Okay. I will go next to Bob Koenig. Bob, you're in the room. You can talk if you go off mic.
Okay. Yeah. Thanks, Dave. Yeah. Good morning, everybody. Thanks to Doug and Mike. Really like the seminar or the presentation today. I did have a question, I guess, since we got a new guy here that knows a lot. So I have a question for Mike. I've been buying to take advantage my cigarette stocks. They're some of the most hated stocks, and consequently they have the highest yields. And I don't care if they fall as long as they maintain their dividend, because I'm always accumulating more shares. So I wanted to see what Mike thinks about my strategy. I'm buying more of Altria and Philip Morris, and the railroad stocks that I like, Union Pacific and Norfolk Southern, since they seem to have a quasi-monopoly on transportation of heavy goods in the U.S. So that's what I've been doing, and I'm buying Kinder Morgan for the high yield, and since natural gas is going to be the #1 energy going forward, it looks like, or along with oil, I guess. So if Mike's still on the line, I'm curious to see what he thinks about buying the cigarette stocks now and the railroads. Thanks.
Yeah, thanks, Bob. And I can't, I'll disclosure, I can't talk about specific stocks on a video cast like this. I'd be happy to talk to you, individually about holdings. But in general, I'll defer to somebody a lot smarter than any of us, and Warren Buffett, right? And he always says if it's addictive and has earnings, buy it. So if you get societal upheaval, remember we've been in the money printing era. So we look at the charts, we remember that Elliott wave, and wealth has been being created, even if it's largely from the increase in the monetary supply. And when things get hard, people turn to things that make them feel better and cope. And we saw some of that in the negative side of that with all the lockdowns after COVID, where you had substance abuse problems and other problems at home. But the societal trend has largely been towards health, right? Better health and better habits, and we've seen that. That said, a lot of those companies, they dominate in those market shares, and if the valuations are lower, you want to, like any company, you want to look at what their debt load is, and if they have healthy balance sheets and you think they're going to sustain the product line, then a lower price is better than a higher one. So I can't say it's not better to accumulate low. I think if the Fed wants the market down, and we know they're going to keep raising prices, then there may be an opportunity to get it at an even better price. So you get into your kind of dollar cost averaging mindset there. But the debt load on any company that you're looking at, any stock you want to be aware of, because of the increase in interest rates and how much it's going to cost them to operate. So companies with high debt structures are going to be under pressure here from an earnings standpoint, just because their financing costs are going up. What was the railroads as well?
Yes.
Yeah,
Yes, the railroads.
So Buffett likes that as well. The issue that you have with the railroads is really just general economic, because they've come under mass consolidation as well. So what's their market share, and what's the general economy going to do? But you're always going to have shipping by rail to some degree. So I don't think the class is a bad one. The question is the valuation at entry.
Yeah, the prices are pretty low right now for the railroads.
Yep, they're lower than they have been, and I'll go back to the general price earnings ratio, and that one chart that I put up that showed the tech stock and at a PE of 25, and if the railroad, what you want to do is just take the specific issues that you're looking at and look at them and say, okay, if the economy slows down and these guys have a hit to 10% activity, what's that do to their earnings? And if the PE comes down overall, if we are going to continue to have some fallout from this, which I think we are, if the Fed's not going to print money and interest rates move at a lag. So before they changed the word pivot for marketing purposes on CNBC, and pivot actually meant a reduction of interest rates, it wasn't unusual for the markets to fall for another 2-3 quarters before you hit the lows.
So you're thinking 23 could be mostly a down year then, as the rates take their effect on the economy?
I think the Fed CPI at 7.7, 10-year Treasury at 4, it's telling us they have a way to go. And when we say they're kind of painted into the corner, I think they are painted into a corner, because if they do it too drastically, they only have a few tricks in their bag other than talking, and it's stimulating by goosing the money supply and fiddling with interest rates. If this market's gonna rally, I think they have to reverse their policy. That's what's carried us all the way up since Greenspan. And I think if they want it to go up, then they're going to have to do it again. And the question then is how much exposure do you want it? And are you looking at a buy and hold? How much skin do you want to put in the game? And are you doing it just for a ride, or versus a long-term buy and hold allocation? But I mean, that's how they lift things. It's lower interest rates and increasing the money supply. So I just know they can't do that for now. But the big risk in this, and a reason they might have to, and then that decision will be on everybody's lap. Okay, here comes QE, and they're going to lower interest rates. Then the decision every investor will have to make is like, okay, well, how much skin do I want in this game for equities, like you were speaking about, and the issue that would force that hand would be a credit event. And there's a slide I used in a recent presentation of zombie companies, and a zombie company is defined as a company whose earnings can't even cover their debt costs, their financing costs. So if they've issued bonds, they're just making enough money to cover the debt service. And at the end of 2020, I think it was like 18% of companies. So if they go too far, like they're going right now, then they have to reverse, because you'll have all kinds of companies going out of businesses and bonds defaulting, and that's when you get a contagion. And again, not cheery stuff, but you want to be informed investors, just being able to think about what potentially could happen. And if you get a big credit event like that, that's a contagion, and everybody runs for the hills. And remember, a lot of this during the easy money era, a lot of people were in the market playing on margin. It was borrowed money, and the collateral that is used for the money they borrowed was in the stock portfolios. And so when you have a big fast sell-off like you had in COVID in 2008 and 2000, that a lot of stuff just gets sold indiscriminately because your loans getting called in.
Oh,
All right.
Comment on Union Pacific, 25 to 50 points lower would seem like a better buy.
yeah, yeah, it could. Yeah, that could happen. And if it goes down 50 points, somebody be buying hand over fist, because I'm in for the long haul, not a trade.
You're in it
Yeah,
for the long haul. Don't worry about this year. We aren't even close to the bottom.
And you're talking about companies that have essentially, they have economic moats, right? That's one of Buffett's tenets is do they have an economic moat? Do they own their market share? And there's not a whole lot of rail companies out there.
Yeah, they pretty much all operate as a monopoly anyway. They share track with one another.
Yep.
4 in the US and 2 in Canada. They share track, they loan one another cars and locomotives. And then all of the major railroads together own the company that leases the rail cars to all of them. So it's really just one happy monopoly, pretending it's not a monopoly. So it's they can't, I don't see how they could be displaced. Yeah, what form of transportation could ever rise up to displace the railroads?
Yeah,
So-
you're always going to have to move goods across the country.
So yeah, great answers. And what's the name of your firm, Mike?
F3 Advisors.
F3 Advisors. Okay, I'm going to write that down. Great. Yeah, thanks for all of your insights. Really
Yeah.
appreciate it.
Yep, you bet. And it sounds like you're identifying targets. So, all the spooky stuff and so forth. I tell people there's nothing wrong with being half right and half wrong. So if you designate a certain amount that you would allocate to a company and you get an entry price that you think is reasonable, you don't have to put the whole allocation in then. You can be half right, half goes lower, then you got a lower price for the other half, or whatever the fraction is.
Yeah, sounds good.
All right. Thanks, Bob. Yep. Nibbling is not a bad idea. Small bites. Next up is David Dennis. Professor Dennis, I'm going to put you in. You didn't put anything in there that you didn't want to talk, so I'm going to give you an opportunity.
Okay, can you hear me?
Good. Yes.
Good. I don't have much, but I wanted to thank Mike and Doug, both edifying presentations, which should have cliff notes attached to them, in my opinion. At any rate, I'm still trying to process some of it.
Tune in next month.
Okay, I will. So I appreciate Mike's introduction to this, where he said one of his outlooks is to, or feels his obligation is to attach meaning via words to the numbers. And this was one of the philosophies I had when I taught accounting and various systems courses over the years, with limited success, by the way, because students want to know the mechanical rules and don't bother us with that esoteric stuff.
Yeah, it's not easy. I'm with you.
Yeah, but anyway, so I've been searching for a post professor title for a business card, and going back to days when I was a student, where they called me a behavioral accountant, which is certainly captures my interest and also much of my training in graduate school.
Yeah.
So social psychology and so on, along with accounting and quantitative analysis. But at any rate, so I'm very much into the idea that there's a great tendency for human beings to look at numbers, remember the numbers, process the numbers, and then divorce them as much as possible from whatever underlying meaning there is. And I look at GE and other large companies that went through various cycles in the last part of the last century of cutting back 10% of their workforce, and then sometimes less than 2 years later, having to hire back most of it because they got rid of 10% because that was the biggest number on their cost of goods manufactured, and then they found out they really couldn't manufacture without those people. So they obviously had not looked at the total meaning there. And that goes to my overall view of the market. And please dispute this, but if you like, that is our system, our economic system does not provide an easy and obvious way to invest excess dollars on the part of the individual, at least, into a worthwhile investment other than the stock market, which leads me to the conclusion, which is the stock market is consistently overvalued because it's too many dollars that have no other convenient place to go chasing what is convenient, which is the stock market and the bond market to a certain extent too. And feel free to, say something about that if you like. So in that regard, one of the things I've always felt, and I don't pretend to be an expert or even an amateur in this area, of the money supply and the money velocity are two key elements of this overvaluation. And so the overvaluation doesn't stay at the same level, it can fluctuate, but those are two key factors in it. And basically that's my comments. Thanks again.
Oh, you're welcome. And I agree that the value, it's a marketplace, and the marketplace is full of all kinds of participants. Some of them are nefarious, a lot of them aren't. And it goes through cycles. So it's made up of human beings and then computer programs. And the computer programs are just tracking or exploiting behaviors. They're looking at whether people are going to take a certain action to buy or sell. And that's your modern marketplace, is a lot of computer stuff. But it's the valuation is elevated, and it is connected to the monetary supply, and it does go over long-term cycles. So your fear and greed index, right? You've all seen the fear and greed index. It tracks what you're doing. So it does ultimately boil down to math, and that's why I think that the PE ratio is a psychological measure. Are people feeling like they have wealth? Well, if your wealth just got reduced by 30%, maybe not. And so your PE, your price earnings contracts. And we have to make an assessment on what the earnings of these companies will be, and if the earnings estimates that are out there in the field are actually valid or not. And I think Disney, Amazon and FedEx just told us a few things.
Fair enough.
I made a note for December, and talked about PE ratios and dividends. And Mike's had that triangle. You can measure stocks by PE ratios, which is what everybody does when they want to gamble. And then you look at the dividend yield on it, and stocks trade within a dividend range. And you can see there's a large disparity between the two until, well, Verizon, the whole communication sector has been an industry that's gotten hit, and you get 7% yield on Verizon. So its PE evaluation and the dividend evaluation get close. So if you wonder how screwed up the market is, look at the divergence between a dividend range and the PE range of stocks. I'm done.
All right. We're making our way through our attendee list. So I think next up, Lou Floyd. I don't see you in the declining anything in the chat box. So I'm going to give you an opportunity to say something if you want to. All right. Next up is I don't see Michael Davala. I'll give you an opportunity. You want to say something? Are we doing that? I'm just scanning to make sure no one put anything in the chat waving their. All right.
I'm here.
Oh, there you are.
Yeah, I'm using 2 or 3 different versions for Zoom, one for work, one for non-work, and sometimes I don't pull all the right levers.
Okay.
It seems to me we've got really, from my observation, we've got 2 different types of inflation. We've got one caused by the monetary supply and one caused by a domestic restriction of drilling for oil and refining oil. Am I right on that?
You are, by my concern. I make a distinction. You've got interest rates that are going to go up because of stupid government policy, particularly the Fed. And then you've got economic inflation concerns. And my contention is you can have declining inflation, but you still could have rising interest rates. That's something we'd talk about in December, or could talk about.
Okay.
Yep, and I'll chip in there. You also have geopolitical stuff going on with the supply chain. So the supply chain was not only domestic as a result of COVID, but you have a lot of stuff that's originating overseas. And you can make the case for you're in economic World War III with China right now, right? So we just saw in September that collectively with Japan, they dumped 118 billion of US treasuries, right? So there's a currency war going on right there. And China has a zero COVID policy, and you won't see anything on the television, but you could go to other media, you could go out to social media and see all kinds of stuff that's gone on inside China, and they have entire cities locked down. And what they've done is they've just rotated locking down some of their biggest ports. So what that's doing is it's causing real inflation. That's straight on your economics 101, supply demand charts. And I'm sure many of you know people and local businesses, or you try to go to the car and they've got all these partially complete autos on the lot because they're waiting for particular parts. And so when we shipped all of our manufacturing overseas, when we shipped all of our pharmaceutical production overseas, all of a sudden we didn't control our own destiny. And I think China's acting on that right now. And it may be nothing more than a cover story that they're worried about COVID and they've got everybody locked down. But that's the kind of society it is. So you lock everybody down, they're not working on the factories and they're not sending the parts in. So they're forcing inflation on top of the monetary policy that we already had. And then the energy is, of course, a domestic impact.
Okay. Thank you.
Thank you, Michael. Next up is Mike Kelly. Mike, I'll give you an opportunity to ask, to speak if you want.
Yeah. So I really didn't want to speak. I sent a note saying.
Oh,
that,
I'm
but-
sorry. I'm sorry.
But no worries. Great presentation. Happy to be here. Thanks for sharing to all of our speakers and those who asked questions as well.
Okay, thank you for joining. I appreciate it. Next up is Roger Long. Roger, glad to have you back.
Okay, thank you. I guess I would address this to Mike. We're talking about the Fed raising interest rates supposedly to suppress demand and thereby suppress inflation. And you made comment on rising interest rates would also, as a sideline, kind of impact the earnings of companies. And as a result, you mentioned the impact on zombie companies not being able to meet their interest payments and going bankrupt. I'd like to expand that a little bit and get your comment. That also happens to non-zombie companies. And the ones I'm interested in are the ones that are basically on the edge of sliding into being junk bond. And as a result of their interest moving them into a junk bond status, institutional investors can no longer invest in those stocks. And I'm kind of interested in what impact that would have on the stock market. And secondly, the rising interest rates ultimately are going to raise the interest payments from the federal government. And I kind of like to wonder what your opinion is that they would do to mitigate that, I guess. Do they have any way that other than raising taxes to pay for the rising interest?
Good questions. So on the latter one, yeah, the interest expense has risen substantially for the government, right? So the only way to reduce that, of course, is to turn around and reduce interest rates, or you have to issue more bonds. And that takes you out to the currency war. To issue more bonds, you have to have buyers of those bonds. So, you know, if this thing gets mathematically messy, you know, and it's a crisis that originates that type of stuff, then you can change the laws. You can mandate treasuries be held under certain investment vehicles and pension plans and things like that. That's a way to get more buyers for your bonds locally. But other than that, it's a straight math calculation. The only thing the Fed can do is they can let maturing bonds roll off their balance sheet. So when they pay, you know, they work with the Treasury and the Treasury redeems an outstanding Treasury bond, then they don't roll it over. They don't issue a new one in its place. And so then you've at least decreased the amount of bonds outstanding upon which you have to pay interest. But all of those things can be deflationary, and you know, that's why they're in between a rock and a hard place, because they've run such an inflationary scheme for so long.
Manny's going to be at Florida West at 1 o'clock.
I'll mute. I muted him. Go ahead, Mike.
Okay. Yeah, I mean, they got to tread the fine line between causing an outright deflationary environment, right? And that's so I think where they are is that unless the goal is to really wreck everything, they're going to have to stop somewhere in that 5 to 7% range. And I'm skeptical they can get there without causing a big mess.
Japan is doing what you're talking about. They are in the deflationary thing. That's what their chart is and their problem.
Right, and Japan, I mean, the Bank of Japan owns a substantial portion of their bond market. Their sovereign bond market is essentially dead. You know, they print money and buy it themselves, and that takes you right back to a Triffin where you have a crisis. And one of the charts you put up earlier, Doug, was how overinflated the Japanese bubble was, and they went so high and to crazy town that it's taken decades just to navigate through it. And they didn't really navigate through it. They're just kind of cheating. They're printing money and buying their own bonds.
I might add on the Japanese front there. My understanding is that the Japanese are actually selling US bonds to raise cash so that they can support the Japanese yen.
Yeah, the currency peg. That's exactly what they did. They depleted some of their currency reserves, and the currency market's pretty big too. And they defended the rate for a while, and you know, then it went the other direction. So they had spent some of their reserves, sold some of their treasury bonds for just that reason, and now they have less reserves, and they're still at risk.
Seems
thank
like
you. That's all I've got.
All right. Thanks, Roger. So I promised I would swing around to this question that I think was posed by a couple of people and probably on everyone's mind. And I think this will be for Mike and Doug and maybe even James Hapner if he wants to chime in here. So, and maybe I can help out a little with this a little bit. It has to do with, okay, based on everything that was discussed today about cycles, about fourth turning, this current situation, economic situation, what were the kinds of investment thoughts you have around this? So let me see if I can help with this with a prompt. In a lot of the financial research that I subscribe to, I seem to be noticing, again, in my head, it's something new, is an investment, I'll call it idea or approach that's now pretty much saying, hey, a good strategy is figuring out how to somehow get through this period of time, whatever it turns out to be, and lose the least amount of money. I'm not kidding. This has been in several pieces of research. And so I know you guys can't talk about individual investments and all that stuff, but in terms of allocation and ideas like that, perhaps maybe you could formulate a response somehow, some way that's doesn't violate any of your, financial advisor stuff.
Yeah. So, I mean, the short answer is, from my perspective, if you just evaluate the math and you respect some of the cycles there, and we say before they change the meaning of words like pivot and recession, do we forecast that it could be difficult times ahead, right? So they've already said more people need to lose jobs, right? So we know there's an impact to that, and the only in the Keynesian world, the only exit from that is through stimulative measures. So that's tax cuts, money printing, reduced interest rates. And until we see that, I'm not of the mindset to get overly greedy. So I think it becomes the stuff that you trust the most. And that means if you're looking at companies, whether they be cigarettes or rails or whatever category you're looking at, beaten down tech companies, you want to look for the ones with the economic moats, with the best balance sheets, and decide when you're going to access those, because you trust those companies, because they have market share, they have moats, and then it's a valuation play, and that's your equity category. In an asset class, large cap value that operates across the globe, healthy balance sheets, products that everybody uses, in the defensive sector, soap, uh, things along those lines. That is food, things you use in everyday life are probably safer than the more speculative plays. And on the fixed income side, that's purely a function of interest rates. So, and we've gone through that before, but they're issuing new bonds every day. And if the new bonds have higher interest rate, the value of all of the existing bonds in the marketplace is going down. If you buy bonds individually, the minute you buy it, what you're going to get on it on a return. I know right now, today, if I buy a 10-year treasury bond, I'm going to get 3.8%. And I can put that away and I know I'm going to get 3%. And I don't even have to look at the gain loss, the unrealized gain loss. As long as Uncle Sam can still print money, I know I'm going to get my money back. And my only worry is what the money will be able to purchase along the way. That gets you into your inflation. Separate and you can ladder that stuff. I could buy a 1-year bond and get 4.67%. I could buy a 5-year bond and get 4.3%. So you can arrange it so that when it becomes liquid cash again. And if you think that's an opportunity to build portfolios like that, when you're going to get your money back, exactly what you're going to get on that allotment of money. And those are liquid markets as well. So you own it. You could sell it any given day that the bond market's open. And if the Fed turns around and lowers interest rates, then the reverse happens. The price of bonds in the marketplace start going up. So you're really at an entry point. And we were talking about a 5 to 7% range, right? We're talking about the 10-year at 4%. So at some point, mathematically, they have to stop and reverse. And so if the rate in the safe assets is both liquid and better than you've seen in a long time, we haven't seen rates that way in a decade and a half. So that is a thing to do. And then you get outside of the treasuries and you want high quality corporates, right? So those some blue chip companies that may give you a little bit more than Uncle Sam for interest rates, same type of thing. And I think it was Roger that had asked about junk bonds and or companies just on the edge of the junk bonds. But junk bonds and the zombie bonds, we say the name and we forget what it meant. They're junk. And so a junk bond was a company that was suspect to even be in existence in 5 years. So back in the day when I started in the industry and back right around the emergence of Greenspan, and Volcker was up at 14-15%, junk bonds were over 20%. Well, that made sense to an informed buyer, because if I'm worried if you're going to be around in 5 years, I want my money back as fast as possible. Well, if the junk bond yield is 25%, I got 100% of my money back in 4 years if the company makes it. But at least it's coming in as fast as I can get it. And what the Fed has done in this quantitative easing monetary regime is they pushed junk bonds back, yields down to between 4 and 5%. So think about that at 4%. You've got companies you don't think that they'll be viable for 5 years, and you're giving them some money. It's going to take 25 years to get your money back, what you originally. So your principal is totally at risk, and that's your TINA. There is no alternative, and that's what they did. Is they defied mathematics through the quantitative easing. So on the bond front, anything that you put into a fixed income vehicle, you want to assess what's the credit worthiness, what's the likelihood I'm going to get my money back here, and authorities that can print or tax are even better than the solid corporates. And those are municipalities, public utilities, things like that. And then the other issue is, the overlying theme was the stuff you trust. Where do you put it? The stuff you trust the most. And then that gets into real assets and real estate. And we just went through what 7% mortgages do to a $400,000 house. They knock it down to 487. If you're going to have people that have a weekly paycheck, or monthly paycheck, buy those assets. So anything that you can own that's a real property is good. Anything you can put in your hands, it's there and it's real. It's going to be needed one day. is a decent thing to have in your portfolio. And the question was asked, I think, about the precious metals. And I mean, historically, precious metals have been the asset that people go to when they lose faith in mankind and institutions, monetary institutions. And I don't think that's any different than today. So in fact, it's kind of extreme today. And so the question is it a decent entry? And how much should I get? And the answer to how much should I get depends on how much liquidity you have to survive day to day, right? So the answer differs for every person in their individual situation. But you know, is it a good entry point if gold's at $1,700 and change and silver's at 21, right? So if you go back to 2008, 2009, well, gold was at $1,700. So all the money that's been printed, gold still is where it is. And silver back in 2008, 2009 was near $50, and now it's at 21. And as Doug pointed out, it's a depleting asset, and it gets used in your cars and your phones and industrial. So it's a secondary, you know, it's the junior varsity monetary replacement when you lose faith in fiat money, and it's at risk of confiscation, like the confiscation that was put out in 1933, right? So there's some risk there. And then how do you want to own it? Do you want to own it in physical form? And do you want to take possession? Do you want to take physical possession and put it in the bank deposit box? Do you want somebody to store it for you and put it in a vault? And there are carrying costs for that. You know, you're basically renting like a cubby hole at some of those firms. And if you do that, there's going to be a charge for that. And you've got to be sure that if there is a confiscation act, that you're not going to lose it, because obviously they go straight to the bullion depositories if you ever get an act like 1933. And again, that's extreme stuff, but a lot of the central banks are accumulating gold, and that includes China and Russia.
All right. Thanks, Mike.
Yep.
All right. I think we've made our way through everyone on the list. Last call. If there's anybody who wants to contribute or ask a question, you can either put it in the chat box, or if you want to chat, let me know. But I think I've gone through everyone.
I'll make a statement on whatever Mike is.
Okay, go ahead.
I run a portfolio and it's at a bank, and they have different regulations. And so you have to go with whatever they got. Yesterday, I put a bunch of money in 90-day, it was 30-day stuff at 3.66%. And I bought, and that was for my fixed income side of the allocation. We had sold, we have equity money, and I bought some of that for, I think, 6 months, and it was 4.56%. So what I'm doing,
that was 30-day that you did for,
yeah,
3.6, because I locked down 3.83 on treasury bills for 30 days.
It's a bank, you do.
Oh, it's a bank. Okay, sorry. Go ahead. I'm sorry. Go ahead.
Oh, they do whatever the hell they do.
Yeah.
But what I'm doing is, you watch the market. Well, you should have a shopping list. And this is a question. Do you have a written investment plan? This is what we can talk about in December. A written investment plan. Do you know when to sell stuff, when to buy stuff? And do you have a shopping list? The market could collapse. You can identify the market collapse, but then, I don't know what to buy.
Right.
So whether you're buying it on PE ratio or dividend yield, this market is subject to taking panics fits and dropping good stuff down substantially. Like you got Walgreens that pays a dividend, increase the dividend for the last 50 years. You had Verizon, like I said, the communication sector got nailed. So I've got a list, and then I'm just waiting for the market to drop down, and then I'm going to buy it. And this is an inflation thing. I don't know how it could be worse or as bad as what it was in the 70s. And my comment to the bank was Newmont Mining and I can buy it at a 5% dividend yield, is in the Standard & Poor's 500, but it's a gold stock. Banks don't buy gold because it's not in their preferred list, because they're playing, and this is a note on Standard & Poor's 500, whatever percentage a sector is what they own. So gold is not part of a sector, so therefore they don't own any, but they've got 30% intact because that's what the index has. The index is the thing that drops 50%. Well,
Right, right.
why not just buy the stuff that you know that you want to own, just have a shopping list and be ready to buy it. That's what's coming up.
Yep.
December, we can talk a lot more. That's what December is about, is kind of strategy planning. This is an interim in case whatever the market does between now and then, but that's a plug for December.
Very good, Doug. Yeah, so everyone, first of all, thank you all. Thanks to Mike Sullivan. Always great to have Mike back. And Doug, of course, there was a lot of material today. So for all of you who attended today, put your thinking caps on. I will be sending out information for December 10th. So pay attention for those emails. If there's nothing else, I'd like to wish you all a great weekend. Thank you for your participation today. And I hope to see you at our next 4th Saturday.
Happy Thanksgiving.
Yes, happy Thanksgiving.
When
Go
is the
ahead.
December meeting, please?
December 10th. Look for the Saturday, December 10th. Look for that information coming out from me from AAII or through the local email reminder.
Yeah, is there a dinner meeting in December?
No, no, there's not. And hey, that reminds me of
Not until
something.
spring.
Yeah, so that reminds me of something else. For those of you that are local, one of the things that Doug and I talked about, and I think this is probably a good idea, is you all recall when we went into COVID, we went 100% into Zoom. And during that period, I know there was several folks that were really wanting to know when we were going to get back and do in person. So we started ramping that up this fall. We started in September. We've had now 3 sessions, September, October, November. And I think it's time for, if you have an opinion on that, the attendance on that turned out, Doug, I won't speak for you, but I think it's been trending lower than we expected. I know before COVID, we had, pretty a healthy attendee list.
35-ish.
Yeah, and we're at least averaging half that. So I guess we need to be thinking about, is the in-person venue worth it? Do we need to do something good? A lot of it has to do with the speaker, right? The speaker's coming, and they kind of expect to have a pretty robust group there. And so far that hasn't happened in September, October, or November. So Doug, go ahead and chime in on this if you want. I'll send out a survey. I think what I'll do is I'll put some information on this December 10th. If you're local and you have an opinion on these in-person meetings, please chime in, give us some feedback, particularly if you attended. If you haven't attended, maybe explain, why you haven't, that kind of thing. But I will ask for that in the reminder message coming up. Go ahead, Doug.
I'm thinking we have 3 meetings. You have them in the fall, you have them in the spring. So you'd have March, April, and May. So it's a matter of whether we have the spring meetings. What you said is fine.
Yeah, so it could be a frequency thing. So I'll formulate something, look for that. That'll be in the email reminder in addition to the December 10th feedback on in-person meetings. So with that, we'll close. Thanks again, Mike. Thanks again to you all. Have a great and safe weekend.
Thank you, Dave.
Thank you.
Yeah, bye.
Bye.